The last couple of years, obviously, we've added support for quite a few things now for Repo. And it tends to be an instrument class that isn't very well known. So I thought I'd just do a bit of an overview, like what Repo is, quite high level. So won't bore you with all the nitty gritty of all the stuff that goes on in the Repo world, but hopefully just helps to understand what's going on. First question: what is Repo? What is a repo? Where does that name come from? Well, it's an abbreviation for repurchase agreement, and we call it a repurchase agreement because someone is selling a bond, and say today, and they're agreeing in advance that they're going to buy it back from that person in the future at a higher price. It doesn't have to be today, of course. It could be tomorrow or the next day or whatever. But basically, there's a start date and an end date. One side is selling, and then they're going to buy it back at a higher price. So that's why it's called repurchase agreement. What tends to be less commonly called is secured lending. At least if you're in the repo market, a lot of people tend to use that term, but outside of it's not as well known. So if you can think of it in reverse, rather than from the point of view of the bond, but think of it in terms of the cash. Think of it from the point of view of the cash. So someone wants to borrow some cash from someone, and they say, "Hey, I'll borrow this cash from you, but I'm going to give you a bond as collateral." So that way, the person who's lending the cash has some collateral. It's like a securitized loan. Same way, like when you borrow money from the bank, your house is the collateral for the mortgage. So, same principle there. And kind of like a pawnbroker, I don't know about that because they don't agree to buy it back from you. A pawnbroker is more like just selling the bond. So that's the other way. And then obviously, if I'm borrowing the cash from someone, I'm going to pay them some interest when I repay the cash to them. And that is kind of like how you end up with the higher price on the second leg, because you're repaying the principal, the amount of money that you've borrowed, plus the interest on top of that. So then when you add that interest onto the principal, you can just go in reverse and say, okay, well, this is the price of this bond based on that much cash. So that's the basic gist of what a repo is. Repo kind of refers to either direction, but actually a repo is technically selling first and then buying at the later date. And a reverse repo is the other way around. So if you buy the bond on the start date and sell the bond on the end date, that would be a reverse repo. And a lot of people might wonder, what's the whole point of this? Well, it's basically like the plumbing for the bond market. So as we know, the bond market is a massive market and there's loads and loads of trades going on all the time. People need to effectively fund those positions. So if you buy a bond and you're like a dealer, especially if you're a dealer, like at one of the banks, you don't necessarily want to just use some of the bank's cash to pay for that bond. So you can go to the repo market and you can then sell that bond out into the repo market where you agree to buy it back at some other date. And that way you fund the open position of the trading operation. So that's sort of like one use. Quantities traded in the repo market are quite big, and they've been growing and getting bigger. Which so the primary characteristics, repo is what you'd call an over-the-counter instrument versus something that like trades on an exchange, like a future or an equity. So because of that, just like an interest rate swap can have a lot of different characteristics to define the interest rate swap, a repo is similar. So there's always an underlying instrument. So that's the bond that's being bought and sold. It can be a basket of of bonds to pick from, which I'll get on and explain later. The repo rate is, like I said before, that's like the interest rate that you apply to the cash that's being borrowed, lent and borrowed. So the guys that are trading in the repo market, whenever they're quoting prices, they're quoting the rate to apply to the cash that's being lent and borrowed. And that can be a fixed rate, so like just 5% or 6% or whatever, or it can be a spread that you apply to a benchmark, such as SOFR, which is SOFR is short for Secured Overnight Funding Rate, which is basically just all the dealers in the US stick in all their trades that they're doing for overnight repo, and then they take an average price, and that's what gets published each day as the SOFR rate. So that's like a floating rate repo. Not as common, but they do exist. Then the term is one of the other main characteristics. So, like I said before, there's always a start date and an end date. The term itself can be fixed, meaning it's going to start tomorrow, and then the end date will be in a week's time, or whatever you want to do. Or it can be for an open term, and that just means there's no defined end date. So you do the first leg of the trade tomorrow, and then you say, okay, we'll leave this trade on open, so I'm just going to close it out sometime in the future, and that time is going to be when either one of the sides, one side of the trade, goes to the other side and says, "Hey, I want to close this trade out now." Or they can do other things as well as close it out, which I'll come on to later. They just need to make sure that they give them enough notice. So typically, you wouldn't do it the same day. You would, at a minimum, tell them a day in advance. Sometimes it can be agreed upon at the beginning how much notice you have to give. So it could be 1 day, it could be 2 days, or whatever. Once you've done the trade, you need to then set a price for the bond itself, obviously. So typically you just look at where the market's trading and say, okay, this is the price. This is less. This is not something that's really negotiated as such, as long as it's like very close to the market. No one's going to be too fussed, but obviously you need to agree a bond price which to buy and sell the bond at. And then the other main thing that you see quoted is the haircut. So what sometimes people will do is they'll say, especially say a dealer has a customer come to them, and the customer might have a lower credit rating, or they're not as well regarded. So they say, okay, I'm going to lend you, I'll lend you the bonds, but I'm going to take a haircut on how much. Other way around. I'll lend you the cash, but I'm going to take a haircut relative to how much this bond is actually worth, to provide me with a bit of cover in case something goes wrong, like you default, and I've got and that way I've got a bond worth more than the cash that you owe me. So if they say haircut of 2%, and you agreed 100 million of repo trade, and the price of the bond you agreed is 100, that's the percent of par price. If the haircut was 2%, then you would exchange 98 million of cash to start with. Okay, so different types of repos. The most basic one is referred to usually as specific or special, and that's when you state up front what the bond is. So right from the beginning of the inquiry, or if it's trading on a club venue, what the bond is going to be. Then there's also what's referred to as general collateral. And this is the case where you've got a whole bunch of bonds on your books that you just want to get rid of them, or more common is the other way around. You've got some excess cash and you want to lend it out, but you don't really care what particular bonds you get as long as it's from this particular basket. So often it'll be, for example, it might be a UK gilt basket where the maturity of the bonds has to be under 10 years. You don't want any bonds that are longer than 10 years, but anything else is fine as long as it's a gilt. So when you do one of those trades, the basket is defined up front, and then once the trade's agreed, the bonds that get provided for this trade is done by the selling side, because obviously they're the ones selling, so they have to say, okay, these are the bonds I'm going to give you. So you might do a trade again for 100 million, and you might say, okay, I've got 3 or 4 different bonds, and I do X amount of this one and Y amount of this one, and so forth. Then you can have a tri-party repo. This is basically the same as a GC repo, but instead of the dealer themselves sorting out the collateral after the trade's been agreed, they go through a third-party agent, and the third-party agent just works it all out for them. So they'll obviously have a bunch of tri-party trades for the day, and the third-party agent will work out who they need to give bonds to and who they need to give cash to and whatnot, and then go and get the bonds that you own that you've given to that third-party agent, and they just sort of do it all for you. So it's kind of like outsourcing that part of the process to someone else, so you don't have to worry about it. There's also something called a locate, which isn't a trade. It's more like an IOI, but in reverse. So you might need to borrow a bond, and so you might send out a bunch of locate inquiries to dealers and say, hey, I'm looking to do this particular repo trade. Do you want to show me a price? And then the dealer might look at it and say, well, yeah, I've got those bonds, so I'm happy to quote this price. And it's basically like an indicative price, and then from there you might agree a trade afterwards after that. So hence why I say it's like an IOI but in reverse. Okay, so I mentioned before about open repo. So there's an open term, there's no specified end date. And when I talked before, you might say one side says, okay, I've got this open trade, I want to close it out now. That's the most basic thing you can do. But there's other things that you can do. So you might only want to close some of the trade out. So that's called a resize. So you might have a trade for 100 million on, and you say, I just want to reduce this to 50 million. So you'll send you'll go to the counterparty and tell them, hey, I want to reduce the quantity to 50 million tomorrow. And normally that works by closing out the existing trade and then booking a new one for the smaller, like for the reduced amount. You can re-rate the repo rate. So often when trades are on open, they're typically done like at the SOFR rate, or like the rate that the bank, the central bank publishes, or something like that. And you might agree that you change, if the central bank changes the rate, or whatever you've agreed to changes, then you're going to change the repo rate on this trade that you've done. So it doesn't affect anything before the day. It's only from the day you say and afterwards that something changes. You can also reprice the bond itself. So that could be because the trade's been open for a while and the price of the bond has changed significantly. So you basically just want to remarket at the current market price, because one side's going to kind of be out on that trade by some particular margin, because the value of that bond has changed so much. So you can reprice it. And the other main one is a substitution. And that might be, okay, I've got this, we agreed this trade for this particular bond. And one side says, I want to give all of that back to you. Sorry, one side might say, the side that's lent the bond to the other one might say, I want to get all of that bond back, but I'm going to give you this other bond in its place. Or partial, it could be, I'm going to give you half of this trade that we've done, reduce it in half, and I'll give you this other bond in its place. So who trades repo? Kind of discussed that a little bit before, but the dealers, the repo trading desk has kind of got two purposes. One is financing the bond trading desk, so that's what I said earlier. So the bond trading desk will have open positions from all their outright trading that they're doing, buying and selling various bonds, and they don't want to go to the market and just borrow cash from the market or from their treasury or anything, because it'll be more expensive. So the repo desk will fund all of those positions for them. So if they've got long open positions, they'll go to the repo, go out. This is typically mostly done in the D2D market. So they'll go to the D2D market and try and repo the bonds out. So they'll sell them and flatten that position for a certain period of time, for a day or 2 days or whatever they might do. And vice versa. Obviously, if the bond desk is selling bonds that they don't own, then the repo desk needs to go and reverse repo those bonds in, because if you sell something that you don't own, you can't give it to the person that you're selling. So that's the same process that's usually known in the stock market. Like if you want to short sell a stock, you have to borrow it first to be able to sell it. So exactly the same thing going on. And then they have customers that want to trade repos with them. Customers, they're typically obviously like bond funds or pension funds, money managers who invest money in their bonds, and then the dynamics of the repo market, it could be such that they can repo those bonds out to dealers and get that cash and invest it in something else. So they kind of like it could be something safe. It might be that the repo rate on the particular bond is very low, so it doesn't cost them a lot to borrow, and they're able to lend that money back somewhere else for and take a little spread on it. Hedge funds do similar things, but they will. One of their strategies could be that they're long the bonds, and then they'll repo those bonds out and borrow that money to invest in like stocks or something to try and increase their returns. So hedge funds are typically more wanting cash to fund their trading positions in other markets. Central banks, they've always been users of repo, but in recent years it's grown a lot because just the way that the market's evolved and what central banks do. So they've been doing both directions as well. So it used to generally be if a bank needed some short-term funding as a last resort, they could go to the central bank and borrow money from the central bank, and they would always have to give them some bonds as collateral. That didn't happen particularly often because that's usually a sign that you're not doing very well as a bank if you need to borrow money from the central bank. That's changed a lot in recent years because there's been so much government debt issued, and banks are having to kind of like fund that, because especially in the US where the primary dealers, they're sort of obligated to buy the bonds at the auctions. So the central bank sort of stepped in and helped them to fund all that trading. So the market is growing a lot as well. Outside of central banks, the banks themselves, before sort of 08, 09, they used to just lend money to each other, just cash, and weren't really that bothered about it. Then obviously there was a massive credit crisis, and they pulled back from doing that. So now the banks themselves tend to fund using longer term borrowing by selling bonds themselves or something. And if they do short term borrowing and lending, it's usually in the repo market. And there was an event that happened in September 2019, which really saw a massive increase in central banks, the Fed especially, increasing their repo activity. So on that day, their overnight repo rate was like 2.4% the previous day, and it went up as high as 10%, which was pretty crazy. The market just completely fell apart. So the Fed stepped in and hasn't really stopped since then. That's just a little chart of the US repo market. So you can see there, and around 2019 it spiked, and then again late 2020, 21, it's gone up a lot, and it's been slowly coming back down again, but still much higher than in the past. And this was the one I was talking about, the reverse repo activity. So the Fed is buying the bonds off dealers to help the dealers fund all those bonds that they're buying from the government, which is kind of like monetizing the debt almost, in a way. And it went up a lot, and now it's come back down because this was around the time they started increasing their rates again, and the market kind of settled down. And so this one is just like, what do we do? So over the past, we used to have just a few post-trade adapters. Over the past 18 months or so, we've added a whole lot more. So GLMX that's a D2C venue. So we got inquiry and post-trade on there. TradeWeb, obviously D2C, has got the same. We recently added DealerWeb EU and US post-trade. Bloomberg VCon, that's a D2C. That's just post-trade. Eurex Repo is D2D, and that's just post-trade, but I think we might be adding inquiry this year, maybe sometime. And then we also have, we did this year before last, with some market data venues for these brokers, BGC, TP, ICAP, and Tradition. So yeah, and you might notice if you worked on any of them, or there's some of our messages have repo specific info groups in them, and that's because, as the name suggests, there's some of those fields that I mentioned earlier on in the beginning that only relevant to repo, so we just stick them in. We added those to our messages rather than creating a separate repo protocol. That's it. Any questions?
So what would be like a main difference that you'd see between D2D versus D2C repo?
So D2C is always going to be the inquiry protocol. So customers sending in RFQs or various forms of inquiries. And D2D is more CLOB-based, so sending orders out or quotes potentially to a venue that's sort of acting like an exchange, but it's not a
so like posting prices and then they just hit it.
Yeah, exactly. Yeah.
Okay.
Yes. Some of those venues work a little bit differently though. So one thing, we were going to build the trading club for ICAP, the US repo. And then when they realized how it worked, they said, don't worry about it. But the way that worked was a little bit odd. So you could send quotes out and orders but then they took into account if they were aggressive or not, and if you had a passive order sitting there, I can't remember how it worked. You could cross over those orders with the same price, but they wouldn't match because one was passive and one. I think if they're both passive, they wouldn't match with each other. Something strange like that. And I think on MTS you have to send an order for a particular quote that's sitting there on the book. I'm not sure. I think that's different from the bond venue, but I know that's a little bit different to a normal club venue. Richard?
So what are the big D2D repo markets? And so I see that we've got Eurex, but are there, and you mentioned MTS, but I didn't see MTS in that list.
Yeah, MTS is another one we need to add. Broker Tech is the biggest, at least in the US, from what I understand. There's one we've been asked about called TransFICC Repo, which I hadn't heard of before. They're asked us about that. MTS is the big one. DealerWeb as well. We only have post trade, but they also have a trading API. Richard?
It sort of seems like you could use a repo trade to take a short position for a bit of time. Is that something that people actively do, or is it?
When you say short, you mean like shorting a bond?
Yeah, exactly.
So when you do a repo trade, you don't really have a position in the bond itself, because you have agreed to, you have a sort of like a time mismatch, but you've agreed to buy it back at basically the same price plus a bit of interest. So that's why it's more like a loan. So you're not really exposed. Your market risk, you won't have exposure to the price of the bond moving. Only the other way around. So if you go to the bond market and sell a bond, short sell a bond, then you need to go to the repo market to fund it, because you've got to borrow it from someone.
So if let's say you need to deliver a bond because you've sold it, this is only like a temporary fix for that, right? You'd still have to get your hands on it long term.
Yeah, you need to keep funding it as long as the position's open. So usually, so the bond desk might take a short position. The repo desk goes and funds it by borrowing that bond. And that's quite often why people like using the open repo type, because then if the trading desk buys the short position back and they're flat, then obviously the repo guy needs to go and do the same thing. So you can just say, I need to close out this open repo, and that sort of makes it a bit easier.
So we do things for e-trading for bonds.
Mm-hmm.
Is there for like repo desks, do they need much sort of IT to support that? And is there an opportunity in sort of e-trading for repo?
So I believe so. We've had customers ask us. I think was asking like this quite a big thing, and I don't know if Tom or Judd are here, but I think it's sort of on the roadmap, but it's like last. So it's swaps, bonds, and then repo would be coming later. But yeah, I think repo is behind both of those markets in terms of doing things electronically. So for example, like tradition US repo, they don't have a trading API. So they have a market data API, but it's just the brokers are getting the prices over voice from the dealers, and then they're sticking those prices into their whatever system that they have to spit out the market data. And that's why it's only ever top of book, because they obviously get complicated if they're sticking in all these different levels. So it's got probably more, it's a bit behind the other markets, the repo market, but it's probably heading the same way. Cool.
So,
all right.
Sorry.
Jonathan?
Yeah. So you were saying for the D2D flows, it's more of a club, and they're publishing prices, and the counterparty just hit the price that they see in the book.
Yeah.
I noticed that we only have post-trade and market data. So I guess they always go to the venue and post the prices there, not through us.
That's right at the moment. Yes, that's right. But this year coming,
Was that the thing that's come?
not what's are I think they're going to want us to build some trading adapters for repo for D2D venues. Yeah, but yeah, you're right. We haven't done anything yet.
The tri-party workflow seems to be a fairly common thing and stuff. But what's the point of it exactly? Like, why would you use an agent in this workflow? What's the, what does it bring? Like,
I think it's a way they use it in a way like custody. So they have to give. So JP Morgan, for instance, or Bank of New York are two of the big tri-party agents in the US. And so a particular dealer, they might keep a load of their bonds with JP Morgan sitting there, and then they just kind of move stuff around in their account, and it's like outsourced, so it can save them some money for their own operations, where they don't need they maybe don't need as many settlement employees or whatever.
so it's outsourcing the whole repo business essentially, right?
All the basically the post-trade part of it for that. Yeah, you're basically outsourcing it.
Okay, cool. Thanks.
And it can, I guess, it helps with it being a bit more efficient with moving money and bonds around. You don't have to do it as much.
Okay, so only small players, let's say, would be using that model, right?
Yeah.
Okay.
You can kind of think of it almost like a clearinghouse.
Yeah, exactly. Yeah, sounds good. Thanks.